Welcome to Capital Allocation Lab.
This is the place where we dig into the foundational ideas of investing in economics, really aiming to give you a shortcut to being genuinely well-informed without you having to wade through all the dense academic papers yourself.
Our mission is, and always will be, centered around the long-term, fundamentals-minded investor.
Right, the person who prioritizes sound judgment and a really robust process over just chasing market noise.
We love revisiting the classics, translating the timeless wisdom from books like Benjamin Graham's The Intelligent Investor into practical, actionable lessons for today's incredibly fast-moving markets.
And if you value that kind of deep analysis, please take a second right now to subscribe and like. It really does help us keep building this free library of lessons for serious investors.
Okay, so today we are tackling something fascinating and, frankly, a little unnerving.
We're looking at the very nature of success in investing, and we're using two incredibly powerful sources to do it. Graham's own postscript to The Intelligent Investor, and of course, Warren Buffett's famous essay, The Superinvestors of Graham and Doddsville.
And the core question we're grappling with is fundamental, isn't it? When you see these truly exceptional, life-changing investment results, how much of that is skill?
You know, systematic, repeatable skill.
And how much is just one massive lucky break?
It's that constant tension every disciplined investor feels. You know, you commit to the hard work, the reading, the analysis, the rational process, but then you see a story in the headlines and realize a single bold decision is what created a legendary return.
Which leads right to the big practical question for you, the listener. If you aren't Benjamin Graham or Warren Buffett, what are the realistic lessons you can actually take from their methods?
How do you benefit from the philosophy without just, chasing the impossible dream of finding your own next GEICO?
Exactly. So let's start there, with that specific story Graham uses to cap off his life's work. The story of his firm's greatest investment, which was also its greatest paradox.
Okay, so Graham sets the scene perfectly. He describes what disciplined, almost grinded-out investing looks like.
He talks about two partners, himself and his colleague, Jerome Newman, it's generally assumed, who ran a client fund for many, many years.
And they weren't famous. They were just quietly compounding their clients' capital through persistent and, let's be honest, often boring conservative effort.
But the results, for that time, they were outstanding. They were consistently earning about 20% annually.
For 2 decades, which is just incredible. And they did it by sticking rigidly to the core rules of value investing.
So avoiding overpriced stocks, trimming positions when valuations got stretched,
and maintaining a very high level of diversification. We're talking over 100 different positions at times. It was the absolute epitome of systematic, low-risk investing.
It's a process built for stability,
right? Yeah.
For consistency, not for making headlines.
Exactly. If you're maximizing safety, you're maximizing diversification. Their clients were getting rich, but they were getting rich slowly, just as they'd been promised.
But then the anomaly shows up.
Right. They get approached with an opportunity to take a big, meaningful stake in a company that was, well, pretty unknown.
It was an insurance company, which is a very unfashionable industry at the time. Wall Street just didn't care.
In fact, Graham points out that several highly respectable firms had already looked at the deal and passed on it decisively. So this was clearly not a hot, in-demand asset.
But Graham and his partner, they didn't care about fashion or what the consensus was.
No, they anchored themselves purely on the fundamentals, the absolute basics. They asked, what are the current earnings? What's the asset base?
And what multiple are we being asked to pay for those real existing numbers?
They weren't buying some 30-year dream. They were buying a highly profitable insurance business, government employees insurance company, GEICO, at what they saw as a deeply attractive price based on its current operations.
And this is where the story just takes a dramatic turn.
It really does. Despite decades of preaching diversification, 100 positions, they did something completely out of character.
They committed a huge portion of their fund.
An astonishing amount, roughly 1/5, so 20% of all their capital, into this single, unfashionable company.
It was this massive, bold act of concentration that just shattered all the rules they had set for themselves.
And the outcome, as we all know, is the stuff of legend. The investment just exploded. GEICO became one of the great investment stories of the century, eventually rising to hundreds of times what they originally paid.
Which leads to what Graham himself called the statistical insult.
Yes, and he was almost painfully honest about this. He calculated that the profits from this one decision, that 20% bet on GEICO,
it ended up dwarfing the combined profits from 20 years of hard, steady, diversified work across hundreds of other stocks.
Think about that. A lifetime of rigorous process was statistically just overshadowed by one single home run.
That is just a staggering thought. If you're the person who spent 20 years grinding out those returns with discipline, only to find out one bold move created most of your wealth, you'd have to confront the role of luck.
But the key nuance here, which Graham is so careful to provide, is that he struggles to call it pure luck. He says it's hard to tell if it was supremely shrewd or just one lucky break.
The distinction is in the preparation, right?
Exactly. That's where the nuance is. What did that preparation actually involve?
For first, they had the reputation and the track record. They had the discipline to even be offered the deal in the first place when others were passing.
Right. They were seen as serious, reliable capital allocators. Second, they had a rigorous valuation framework. They knew the downside risk. They knew what assets they were buying and what a conservative floor looked like.
So it wasn't a blind guess. The numbers were anchoring their decision.
And third, and this is maybe the most critical part, was the temperament, the courage. When the numbers aligned so profoundly, they had the capacity to act decisively, to commit a massive amount of capital when everyone else was just indifferent.
That kind of courage isn't luck. That's something that's earned over years of validating your own process.
There's another subtle layer, too. Graham admitted the stock pretty quickly became too expensive by their normal rules for diversification and valuation.
But they held on.
They held on to that large stake for decades, not because the quantitative rules said to, but because they understood the business so deeply and trusted the management. That's a qualitative conviction that, sits a bit awkwardly with pure quantitative value investing.
This is such a powerful lesson for today. Your job as an investor isn't to just abandon diversification and swing for the fences.
Not at all. It's to build a process so robust and disciplined that it gives you two things. First, the stability and diversification you need to survive your own errors.
And you will make errors.
You will. And second, it gives you the valuation framework and the temperament to recognize an unusually favorable beta GEICO when it appears, and then have the courage to lean in.
Graham's humility at the end of it all is what makes it so powerful. He doesn't give you a formula to become a billionaire.
No, he just affirms that there are multiple ways to succeed in the market, but all of them, every single one, demands preparation, discipline, and a temperament that doesn't just panic when faced with uncertainty.
That phrase is key, isn't it? A temperament that doesn't melt in the face of uncertainty. That takes us right to our next point. Graham and later Buffett were absolute masters at distinguishing between managing risk and just trying to avoid it.
It's a fundamentally necessary distinction for anyone who wants to achieve, professional level returns.
Because avoiding risk is this search for a myth, right? This magical setup where you can invest a lot of capital and absolutely nothing bad can ever happen.
It's an impossible search for perfection that just paralyzes you.
Whereas managing risk means accepting that uncertainty isn't some temporary bug in the system.
Right. It's the permanent normal condition of the market. It means you acknowledge all the unknowns, geopolitical, economic, competitive, and you systematically decide which of those you're willing to own.
And, most importantly, on what terms?
Yeah.
What price are you willing to pay to take on that uncertainty?
Exactly. Jason Zweig, who is such an insightful commentator on Graham, makes this point so vividly. If you read the news, you constantly see headlines claiming markets hate uncertainty.
All the time. They cite wars, political dysfunction, recessions
as reasons for market jitters. But when you zoom out, you realize uncertainty isn't the exception, it's the absolute rule.
There's never been a moment in history, not in the Roaring '20s, the Cold War, the tech boom, where an investor could be 100% certain at the next 5 years.
Zweig's conclusion is profound. Uncertainty and investing are basically synonyms. The act of investing itself requires, a degree of faith.
Even for the most data-driven analyst, you're trading certain cash today for highly uncertain cash flows tomorrow.
Right. You have to, at some basic level, believe that the future, in aggregate, is going to be better than the present.
And this is why Graham loved classical literature. He used that analogy of Ulysses sailing into unknown waters.
And the point wasn't to be a reckless hero. It was that Ulysses prepared his ship and his crew to stay on course, to navigate the dangers he knew were inevitable.
For an investor, that preparation is both financial and psychological.
It has to be. You prepare your portfolio with low debt, with diversification, with a margin of safety, so that if a sudden economic storm hits, you don't panic.
You're equipped to stay the course and even exploit the opportunities that panic creates, instead of, becoming another victim of it.
So if uncertainty is the permanent condition, the question is still there. Does skill even matter? Or is it all just a coin flip?
And that idea of preparation and staying power is the perfect bridge into the intellectual proof that Buffett offered.
Right. Buffett tackled this exact question head-on in his essay, The Superinvestors of Graham and Doddsville. He starts with this brilliant thought experiment to just get rid of the idea of pure randomness.
The famous coin flipping analogy.
Yes, he asks us to imagine 225 million people, the entire adult population of the U.S. back then, all flipping a coin every morning. Heads, you win and double your dollar. Tails, you lose, you're out.
So after 10 days, you'd still have thousands of people who'd flipped 10 heads in a row. They'd have turned their $1 into over 1,000.
And after 20 days, you'd have a couple hundred people who had guessed right 20 times straight. They'd have turned their dollar into $1 million.
Yeah, those winners would feel like geniuses, wouldn't they?
Oh, absolutely. They'd be celebrated. They'd write books about their unique technique and vision. But statistically, we know it's just the law of large numbers.
If you start with a big enough population, some people are going to achieve statistically improbable results just through sheer random luck.
Right. Buffett's brilliant counterpoint is that if you ran the same experiment with 225 million orangutans, you'd also end up with a couple hundred with perfect records.
The message is clear. Looking backward at winners can easily confuse luck with skill.
So here's the crucial twist. Buffett says, what if after 20 years, those 40 consistent long-term winners didn't come from random zip codes all over the country,
But they all came from the same specific intellectual training ground.
what he called Graham and Doddsville? Then you absolutely have to investigate the method. Randomness just can't explain a systemic cluster of outperformance from a shared philosophy.
And this small intellectual village was real. It was populated by investors like Walter Schloss, Bill Ruane, Charlie Munger, the Sequoia Fund.
And others who had all independently learned and successfully used the core teachings of Graham and Dodd.
The common thread, their shared intellectual operating system, was strikingly simple.
They focused solely on the relationship between price and intrinsic value. That was it.
They weren't all buying the same stocks. Schloss was diversified in cheap, sometimes low-quality businesses. Munger and Ruane were concentrated in high-quality compounders.
But they shared that same denominator. They systematically ignored the academic theories of the day, like beta, which measures volatility as risk, or these complex statistical models.
They only cared about one thing. Were they buying a business for significantly less than a reasonable estimate of what it was truly worth?
And Buffett's conclusion is that this method provides a genuine systematic edge. It's not about finding some hidden piece of data. It's about applying a rational framework in what is often a very irrational market.
This leads to that fundamental inversion of academic risk theory.
Right. The academics argued that to get higher returns, you must take on higher risk.
But Buffett argued that consistent value investing achieves the exact opposite.
He said that if you are consistently able to pay 60 cents for a reasonably solid, verifiable dollar of value, the margin of safety principle, you are actually lowering your risk relative to the average investor.
Even while you're dramatically increasing your potential long-term return. How does that work in practice?
Well, think about building a bridge or writing an insurance policy. In engineering, if a bridge needs to hold 100 tons, the engineer doesn't design it for exactly 100 tons.
Of course not. They design it to hold 200 tons or even more.
That extra capacity is the margin of safety. It's not there for the known weights. It's there to absorb the unknown unknowns, a sudden material flaw, unexpected weather, an unforeseen change in the load.
And in investing, it's the exact same concept. Margin of safety means you're not aiming for some hyper-precise valuation. You don't need to know the stock is worth exactly $83.27.
No, you use a conservative method to establish a likely floor. You say, this business is worth at least $80 per share.
And then you demand that significant discount. You insist on buying that share for, say, $50 or $55.
Right. That $25 to $30 buffer is your margin of safety. It protects you if your analysis was a bit flawed, or if the market crashes, or if the competitive landscape shifts on you.
You bought it so cheaply that even if your $80 valuation drops to $65, you're still profitable. And crucially, you're still protected from a permanent loss of capital.
And that ultimately is what allowed the GEICO decision to be so profitable, yet still fundamentally sound. It was chosen because it met that same high standard, a profitable business bought cheaply, even though it was a much bigger allocation.
The systematic framework gave them the courage for the single successful deviation.
Now, Graham was writing at a time when the biggest risk really came from buying fragile companies. But later in life, he saw that the nature of speculation was shifting.
A new dominant form of risk was emerging.
Historically, like you said, speculative risk was endogenous. It came from inside weak companies. You were speculating on whether some deep value cigar butt could survive its debt load or turn around its shaky earnings.
The risk was in the business itself.
Exactly. But Graham saw that as balance sheets got stronger and information flowed more freely, that risk was being replaced by a massive new source of risk: exogenous risk.
External risk. Risk driven by market consensus, expectations, and wild projections.
Today, a high-quality, profitable business, a wonderful company, doesn't necessarily protect you from risk. In fact, its very quality and its perceived growth can attract intense speculation.
Investors become willing to pay almost any price for that perceived certainty and growth.
And the danger here is rooted in this temptation to use mathematical precision. Graham got very concerned about investors who were combining these incredibly elaborate financial models
These complex DCF spreadsheets with multiple tabs.
with highly fuzzy, often just wildly optimistic assumptions about a future that's 20 or 30 years away.
The math is precise, but the inputs are pure fiction.
That's the trap. If you project a 15% growth rate for a great company for 25 years, the math will flawlessly justify a truly astronomical current price. The beauty of the spreadsheet becomes an instrument of self-deception.
You're treating an uncertain future as if it's a mathematical fact.
He saw this fascinating inversion of value. Historically, investors were cautious about goodwill or future potential. But in these speculative manias, the market applies a modest multiple to the tangible, known earnings of today.
And then applies a massive, often unwarranted multiple to what they call excess growth.
Which is precisely the unknown, fuzzy part that's most likely to disappoint you.
We see this pattern all the time. The market values the promise of market share dominance or some disruptive tech at 50 or 100 times future sales.
While at the same time, a fundamentally sound business that makes essential parts and generates predictable cash flow trades for 8 times earnings just because it's boring.
Graham's warning here is absolutely timeless. Do not mistake a wonderful business for a wonderful investment at any price.
When you pay 50 times future earnings, you have completely eliminated your margin of safety. You're accepting this profound risk that any disappointment, no matter how minor,
A slightly lower growth rate, a new competitor.
will cause that valuation multiple to compress dramatically. And that compression will damage your capital, even if the business itself is still doing well.
It's damage from exogenous speculation, not from endogenous business failure.
He backed this up with historical examples. He talked about the speculative wave in the late 60s and early 70s. Tiny businesses would go public after just one good year.
And they'd be valued at higher PE ratios than massive, stable, blue-chip companies.
Many were these early technology or electronics firms, anything that sounded like the future. They had little revenue or earnings history, but because they were novel, capital just flooded in.
And as Graham noted, when growth inevitably slowed down or reversed, a huge percentage of those stocks just collapsed. They lost 80–90% of their value and basically vanished.
We have seen that exact pattern play out in recent memory. You just have to look at the excitement around certain SPACs or some of the profitless tech stocks a few years ago.
The market takes the success of 1 or 2 genuine winners and extrapolates it to hundreds of unproven, often debt-laden, smaller players.
That huge speculative wave comes with zero margin of safety, and when reality sets in, that capital is permanently impaired.
So, if the extremes are both so risky, the fragile beat value bets on one side and the high-flying speculative growth on the other, where does Graham suggest an intelligent investor should focus?
He suggests the safest and ultimately most profitable zone is the middle course.
And this isn't just about diversification, it's about a specific type of company.
The middle course is made up of companies that are financially solid, clean balance sheets, reasonable debt with decent established growth records, but not outrageous growth, not growth that's priced for perfection.
And they trade at reasonable multiples that still provide a clear margin of safety.
These are often the neglected businesses. They're not the headline grabbers, they're not the subject of dramatic analyst calls, but precisely because they lack that speculative spotlight, the relationship between their price and their intrinsic value is often far more favorable for a disciplined buyer.
This is where that long-term compounding really happens, isn't it? Solid businesses bought at sensible prices that just chug along, steadily generating cash flow outside of the speculative glare.
They're neither a fragile cigar butt nor an impossibly expensive blue chip. They're right in the middle.
Okay, let's try to synthesize all of this. Let's take the GEICO paradox, the logic of the superinvestors, and the dangers of speculation, and turn it into a clear, practical, five-part checklist that you can use.
This is how we translate that timeless philosophy into actionable, repeatable habits.
All right, number one, anchor on intrinsic value, not price.
This has to be the first step, always. Before you even look at a stock chart or the news, you have to assess the underlying business.
What are the normalized earnings over a full cycle? What's the balance sheet look like?
If you were going to buy the entire business privately, what would a rational, patient buyer actually pay for those cash flows? You have to establish a conservative value range.
And if you can't confidently establish that range, say $80 to $100 a share under conservative assumptions, then you don't know the business well enough. You shouldn't own it.
Don't let the current market price dictate your opinion of what the business is worth.
Okay, number two, demand a margin of safety.
So if you establish that conservative value is $100, you have to train yourself to insist on a significant discount. Resist that temptation to buy at 95 because of FOMO.
You have to wait for the price to drop meaningfully to maybe $60 or $70.
This practice turns uncertainty into your friend. It acknowledges that errors are inevitable both in your analysis and in the market's behavior. Demanding that discount builds a buffer against those unforeseen shocks.
It's the operational rule that systematically lowers your risk, just as Buffett showed with the superinvestors.
Number 3. Diversify intelligently, but make room for conviction.
For the vast majority of your capital, sensible diversification across sectors and geographies is the intelligent way to manage the statistical inevitability of error. You will be wrong.
And diversification is the insurance against those errors destroying your entire capital base.
However, you also have to be ready for a GEICO moment.
Right. When all your homework aligns, the business is understandable, the price is deeply discounted, the runway is long and stable, you can't make the mistake of treating it like a rounding error.
You don't have to bet 20% like Graham did. But if the conviction is truly earned through hard, objective work, you have to be willing to lean in and make it a meaningful, asymmetric bet.
Number 4 is a behavioral one. Distrust, excitement, respect, boredom.
Excitement is the signal that exogenous speculation is driving the price. When everyone has a strong narrative about a stock, when it's trending on social media, your internal alarm should be ringing.
Ask yourself that cold question. If this company were delisted tomorrow and I couldn't sell it for 5 years, would I still be happy to own the underlying cash flows at this price?
And conversely, pay close attention to those boring, unsexy businesses that just drift down to low single-digit earnings multiples because of market neglect.
Neglect is where the price-to-value relationship often becomes the most favorable.
And finally, number 5, focus on temperament as much as technique.
We noted earlier that the arithmetic of value investing, buying dollars for less than $1, is relatively simple. The hard part is the psychological endurance required to actually execute that plan.
Especially when markets are either gripped by euphoria or paralyzed by terror.
Exactly. This is why Graham and the superinvestors put such an emphasis on character traits. Intellectual honesty about what you know and what you don't, avoiding the urge to overtrade, and being comfortable looking wrong for long periods of time.
True long-term returns are so often earned in the waiting, not in the frenetic buying and selling.
If you take nothing else away from this, hold on to these 2 ideas. 1, uncertainty and successful investing are inseparable. Your edge lies in how rationally you manage that uncertainty, not in trying to predict it away.
And 2, success over decades is determined by the steady, systematic application of that margin of safety mindset, coupled with the earned courage to act when the evidence is overwhelming.
That consistent process matters far more than relying on a single lucky break.
Your goal isn't to become an investing legend or to replicate Graham's GEICO score. Your goal is to become a disciplined allocator of your own capital.
It's about consistently making a series of sensible, well-priced decisions that, over decades, systematically tilt the mathematical odds in your favor.
And that is exactly what we strive to do here at Capital Allocation Lab. Take these powerful, timeless ideas and help you convert them into better, repeatable habits.
If you'd like more discussions where we walk through classic texts and map those lessons to today's market, please let us know in the comments. We really do use your feedback to shape what we do next.
For example, tell us if you want a detailed breakdown of different ways to calculate a margin of safety, or maybe a debate on dividends versus buybacks in capital allocation.
Or even specific case studies of modern businesses that you think exemplify Graham's middle course.
And if you have a specific question about applying these principles, ask it directly. We build our future Q&A discussions from your practical questions.
Questions like, how do you consistently tell the difference between buying genuine quality at a fair price versus just chasing quality at an expensive price?
Thanks for joining us for this deep dive into risk, luck, and skill.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free and add light for long-term, fundamentals-minded investors like you.
You've been listening to Capital Allocation Lab, where we revisit the great investing ideas and translate them into better decisions for today's owners.
Now, before you go, consider this thought, which builds on Graham's humility. If systematic skill is the key to compounding success over the long run, what is the single greatest risk to your consistent process right now?
Is it the external uncertainty of the market, or is it the internal instability of your own temperament?
We'll see you in the next one.